Hi guys, welcome to Stock Brains. My name is Ayush and today in this video we will talk about breakouts, stops and retracements. And I think breakout is one of the most famous topic in technical analysis, and people talk a lot about breakouts because they are so profitable to trade on and people love trading breakouts. But there is a risk which is associated with trading breakouts. So it is very profitable to trade breakouts, but at the same time it is very risky if you trade breakout. So in this video we will discuss what are breakouts, we will discuss about stops as well. By stops I mean to say stop losses, and we will discuss retracement as well. So it is one of the most important concept of CMT exam, and a lot of questions come from this chapter as well. So I think if you want to clear your exam, then you must understand the concepts which are there in this subject or in this chapter. So let's begin. So after this video, after you watch this video, you will be able to understand what is a breakout. You will be able to understand what is a breakout and how does it work. You will know the A to Z of breakout. Then you will understand the major methods to identify a breakout. Then we will discuss the purpose of entry and exit stops, how to use stop loss, how to use targets, how to keep that, how to do risk management. We will understand that as well. And after that we will discuss some major methods which you can use to enter and exit in breakouts. So I hope this video will help you a lot, and this video is a part of our Stock Brains channel where we upload all the videos which are related to CMT level 1 exam, and we upload every video chapter wise so that you don't miss out anything. So we will upload all the videos which are there for CMT level 1 syllabus, and we will cover everything from A to Z, and we are making these videos to help you people to clear your CMT level 1 exam in easiest way possible. So if you want to watch these video, then check link in the description. I have mentioned the link in the description, so you can access this playlist very easily if you go to our YouTube channel, and subscribe to this channel if you want to watch more videos like this. Now let's go back to our breakout topic. So first let's understand what is a breakout. So a breakout occurs when a major price breaks out a prior support or resistance level. So breakout happens whenever a price breaks its support or resistance level, and it has to be significant. So whenever breakout happens, it tells you that there is significant change in demand or supply. So whenever any breakout happens, it tells you that the demand or supply dynamics have changed. So let's understand this breakout thing on our trading view. So right now I am there in trading view, and I would like to tell you some examples of breakout for your better understanding. Let's find out a good example of breakout. I think I have got one. So here you can see that the trend is up. Let me draw this line. The trend is up, and you can see that the stock was going up and up, up and up. But here you will find that a resistance came in. So this pattern is known as double top, where stock was taking resistance. Stock was facing resistance from this point, which is near 3140 rupees level, and you can see that then the stock break out suddenly one day, and this is where the breakout happened, right? So in this case you can see that the previous trend was up, but here the due to resistance, this uptrend got stalled. It was not able to go up, the stock was not able to go up. But after this breakout happened, suddenly you see that the stock started going up. So breakout can happen in trend continuation as well. So the previous trend was up, the stock started consolidating, but after the breakout the trend continued its previous direction. So breakout can also occur in continuation as well. Now let me show you another example where the trend got changed due to this breakout. So let me remove all of these drawing so that we can move further on. So let's move a little bit ahead, and you can see there that the stock broke down, right? So this is an example of reversal, where the reversal happened. Let me draw a trend line so that you can understand the previous trend better. So here you can see that the previous trend was up, right? So the previous trend was up. Why the previous trend was up? Because the stock was making higher highs and higher lows. But here you can see that the stock broke out its previous levels, and suddenly the trend got changed. So previously the trend was up, but now the trend is down. So these breakouts can help you identify trend reversals as well. So breakouts can occur in trend reversal as well as in trend continuation. I hope this thing is clear to you. Now let me remove this drawing and let's move further on. Now you can see that we have discussed that these breakouts can occur in continuation as well as reversal of trend, and these breakout occur at important levels. Like in this example you can see that I drew a trend line, right? I drew this trend line, and when the stock broke out, it broke this major and important level. So whenever any breakout happens, it breaks its major support or resistance level or maybe a trend line. So whenever any major level breaks out, then only we say that it's a breakout. Not every stock fall or every stock rise the breakout. Whenever any major support level or resistance level break out, then only we say that it's a breakout, right? I hope this thing is clear to you. Now let's talk about some things which you should remember while talking about breakout or while analyzing breakout. So a breakout in the direction of previous trend signals continuation of the trend. So when the previous trend is up, after the breakout also the trend is up, then it tells you that the trend is continuing and the trend is healthy. The previous trend which was there is a healthy trend, right? But whenever a breakout happens in opposite direction, then it tells you that the trend has reversed, and the trend which has reversed is likely to continue in the long run. Now the third point is the point at which the breakout level occurs is very important. Now this thing is, I think, very important and you must understand this thing. So let's go back to our previous example where we saw that the breakout happened, and let's analyze that level as well. So here you can see that the trend was up as usual. Let me draw the trend line, and at this green candle you can see that the breakout happened. This green candle is, I think, the most important candle to analyze in this chart. Why? Because this candle gave a breakout, right? And through this candle only we will have to analyze whether this breakout is right or wrong. So if this candle is kind of very big and giving us good signals, then we can analyze that okay, the breakout is good. But if this candle is not showing us some good signals, then we will be not making any positions, because we will feel that this breakout may be a false breakout. So this candle which is made while this breakout is very very important, because this candle will decide whether the breakout is right or wrong. So the point at which the breakout happens is the most important point in the trend when this happens. So I hope this thing is clear to you. We will understand different methods to analyze whether this is a right breakout on or a wrong breakout, false breakout or a good breakout. We will understand this thing very shortly. Now let's talk about how the breakout is confirmed. So breakout should be a penetration of previous trend line or a support line or resistance line. If you look at this example carefully, then you will find that the previous resistance level which was there was broken with quite force, right? So whenever any breakout happens, it penetrates previous trend lines or resistance line or support line, and that penetration should be a real breakout, not a false one. And how would we analyze whether the breakout is real or false? We will understand some methods very shortly. So let's go to these methods. So there are some techniques through which we can check this breakout confirmation, whether the breakout is right or wrong. We can understand this thing by using these techniques. Now let's go back again to our trading view and understand these things. But before that, I would like to point out these methods. The first method is close filter, the second method is point and percentage filter, the third method is pivot points filter. Sorry, pivot point filter is the third method. The fourth method is time filter, and the fifth method is volume filter. These are some of the methods which people use to check whether the breakout which has happened is real or false. There are other methods as well, but these methods are the most famous ones, so that's why we are discussing these ones. Now first let's talk about close filter, and to understand this thing we will have to go to trading view. So let me remove all of these things, let me remove all the drawing, and we will take a very good example to make you understand this concept well. So let's go ahead and let's go ahead in time and figure out a period where this thing happened. So right now what I am going to do is that I am going to play a bar replay, right? So I have hided all the data which is after June 2021. So you can see that this is the price action we have got, and suddenly the trend got changed, right? And the prices started going down. Now what I'll do is that I'll draw a trend line. I'll draw a trend line over there, and you can see that if I draw this trend line, then the pattern would look like this. So this is the pattern which formed, and if I draw another trend line which I should draw by joining supports, then you can see that a wedge pattern has occurred. This is known as wedge pattern, which we will discuss in our later on videos. So this is one of the long-term patterns which you may find in charts. So you can see that this pattern occurred, and after that the breakout also happened. So let's play this bar and see how this played out. So I just played out very recently, and you can see that there is a breakout which just suddenly happened. So now we have to analyze whether this breakout is right or wrong, right? So we will have to analyze that, and to do that we will use some indicators. So the first indicator which we had was close filter. So in that what we have to do as an analyst is that when this breakout happened, this green candle occurred. So we will have to check that whether the close of this green candle is above this trend line or not. In this case, the close of this candle is very much above the trend line. So as per this close filter method, we will say that okay, the breakout is a good one, a real one, and we can trade on that. But if this green candle is below this trend line, I am talking about this trend line. Let me make it red. So if this green candle closes below this red trend line, then we would say that okay, this is a false breakout and we should not trade on that. Let's say if the candle would have been somewhere over there, then we wouldn't have traded this breakout, right? I hope this thing is clear to you. And this is close filter which some people use. Now after close filter, there's another filter which is known as point or percentage filter. Now what is this thing? Let me try to tell you. In this percentage method, what they do is that, let me tell you. So at this level, you as you all know that at this level the breakout happened. So in percentage method, what we will do is that we will just the length of this, we will measure the length of this. So you can see that when the market went up, this candle made a 11% move, right? So what some people do is that if this breakout candle is above 5%, then we would say that okay, the breakout is real. And in this case, you can see that the green candle went up straight away 11.55%. So if you use this technique, then you would be satisfied and you would say that okay, the breakout is real because it has passed our percentage filter list. So some people would use a 7% list, some people would use a 5%, some people would use 3%. It's all up to you, and you can decide what percentage do you want or what points do you want. What some people do is that if a breakout candle is more than 100 points, like if the breakout candle is bigger than 100 points, then only we will consider that the breakout is real. Otherwise we will say that the breakout is false. Now let's talk about the third method, which is time filter. So what some people do is that they wait for some time to check whether the breakout is real or not. So for that, what they do is that after the breakout happens, they wait for 2-3 more candles. So let me play this out. So after the breakout candle, if I wait for three candles, and if I am able to see that okay, after the three candles, the trend is still up. The trend hasn't gone down. This price action hasn't gone below this point. So I would say that okay, since the candles are above this breakout level, I would say that okay, it's a buy, it's a real breakout. So some people use this tool as well to analyze whether the breakout was real or false. So this is one another technique which you can use to analyze the breakout. I hope this method is clear to you, where people use time and wait for 2-3 more candles to see whether the trend has changed really or not. But it has a disadvantage as well, because if you wait for 2-3 more candles, then the stock may go up dramatically and you may miss the opportunity to profit from. So it's always a trade-off between identifying signals early on and identifying good signals with confirmation. If you wait for confirmation, then sometimes you may lose an opportunity to profit. I hope this thing is clear to you. Now let's talk about our fourth method, which is volume filter. So in volume filter, people say that if at the level of breakout, if at this point, if the volume is high, then I would say that the trend change or the breakout which has occurred over there is very real. If if the volume is low at this breakout candle, then I would say that it's a fake one, and I should not trade on that. But this thing does not happen every time. Sometimes what happens is that even if the breakout has happened, but the volume remains very low. But even if the volume is low, it does not mean that the breakout is fake or not real. Even if the volume is low, the breakout may sometimes be real. But if the volume is very high while the breakout has occurred, then it is highly likely that the breakout is real. So let's understand this thing by putting up volume. So I'll use volume vars so that you can understand this concept very well. So you can see that while this breakout happened, so breakout happened somewhere over there. You can see that at this point the breakout happened, and you can see that a sudden spike in volume is there. And before that, you can see that the volume was going up, right? The volume was going up. This thing is known as accumulation, which happened before this volume spike. This thing was accumulation, and this thing was spike, right? This thing was spike. I hope this thing is clear to you. So while this breakout happened, spike occurred, and whenever this thing happened, we say that okay, the trend is good. The breakout which has occurred very recently is a good breakout, is a real breakout, and we should trade upon that. So this is another method which you can use to trade the markets. Now let me remove these lines for your better understanding. Let me remove all of this thing. So this was the fourth method which we discussed, and volume is very important for some traders or some investors. Some people use volume a lot, and it is very much common to assess the breakout through volume indicator. I hope this thing is clear to you. Now let's talk about our fifth filter, which is pivot point filter. So some people use standard pivot point or maybe central pivot point to identify major breakout level. So let me go again to this trading view, and in indicators we will type pivot points standard. So let me just put this up, and you can see that at this green candle where the breakout happened, you can see that the candle was taking support at pivot level, right? So it was taking support and pivot level, and thus it was telling us that okay, the trend which has changed is very much real, and now the trend direction may change. Before the trend was down, but now the trend can be up, right? So this support level which this candle got from this pivot point was telling that okay, the trend direction has definitely changed for sure. So this is another method which some people use to analyze whether the trend has changed or not, whether the breakout is real or not. So these are the five methods which we used, and these are just five methods we discussed. There are other methods as well to figure out whether a breakout is real or fake, but these are the famous ones. That's why we discussed that. Now let's understand what would have happened after the breakout. So we used five methods, and all the methods gave us the same signal that it's a buy, right? It's a buy, the trend has changed, the breakout is real. So now let's see whether the breakout was real or not. So I have replayed the bars to see what happened, and you can see that the breakout was real, and we confirmed that by applying different methods to identify whether the breakout is right or wrong, true or false. So I hope this thing is clear to you. Now let's talk about stops. So stops is an order where you buy or sell the stock at a particular price. Whenever a particular or specific price has been reached, then only you would buy or sell a particular stock. So this is what stop is. So now in our layman's language, we say that I am using stop loss, or I am using target orders, or I am entering at XYZ level. So we have a lot of different terminologies to say these things. But when I talk about CMT book, then CMT book says that there is a stop order, and a stop order has two types. So the language which we use generally is very much different from the academics language or the bookish language. So we will have to understand these things from academics point of view. So there are two type of stops which are there. The first one is entry stop, the second one is exit stop. Now let's understand this thing. So entry stop is the stop which people use to enter in a position. So what are these things? Let's understand this thing. So let's go back to our Bajaj Finance example, and let's go back to this 2020 example where we used different methods, right? So I think this is the point which we used and where we tested our different methods of breakout. So let's say if I buy at this point, let's say if I buy at this point, right? So if I am initiating any position, that means I'll have to put up some money. So let's say if I buy at 2100 rupees level, if I buy at 2100 rupees level, then I'll have to pay 2100 rupees in order to buy this stock, right? So I am initiating a position, I am entering in a position. That's why I am saying that okay, I use entering a position, and this position or this order should be known as entry stop, right? I hope this thing is clear to you. In technical terms, they say that it is a entry stop. Or when do you take a entry stop? Whenever any upward breakout has occurred, or resistance level or support level has been broken. In this case, you can see that a major trend line was broken. That's why we took the entry, right? So this is known as entry stop. I hope this thing is clear to you. When you initiate a position, you put up a entry stop in the system. Now let's talk about exit stops. Now there are two kind of exit stops. The one stop is used to protect your capital, and that is also known as protective stop. The other stop is also known as trailing stop. So there are two situations which may happen with you. So let's go to trading view again. So now let's assume that you have bought Bajaj Finance at 2100 rupees level. Now what can happen? What is the probability? Now there are only two probabilities. Maybe the stock can go down, right? This is one probability. If the stock goes down, you will have to face a loss, right? You will have to face a loss. But there is another probability, which is the stock can go up as well, right? So either a stock would go up or go down. So there are only and only two possibilities. So if the stock goes down, I'll have to use my protective stop loss, right? So let's say I have a stop loss somewhere over there. I have a stop loss at this point. So if the prices goes down, then my stop loss would trigger out, right? So after this thing would trigger, I'll have to exit my position. So this thing is known as protective order, because I don't want to have further losses. To prevent further losses, I'll have to put up a protective loss, right? A protective stop order. I hope this thing is clear to you. To protect losses, we use protective stops. But whenever you are in profit, you use trailing stops. When you use trailing stops, whenever you are in profit. So in this case, you can see that the stock went up, not went down. So let me just remove all of these things. So let's assume that you bought at this point. Now the stock is up, right? Now the stock is up. You can see that the stock is going up. Now the question is when to exit. When do I exit from this position? And I should be able to exit at a position which can give me maximum profit, right? So when I am profit, I would like to take the maximum profit and try to book my position at the highest level of trend, right? So to book your profits at a good level, we use protective stops so that we can follow the trend as much as possible and we can exit at a good time. I hope this thing is clear to you. Now let's talk about trailing stops. We have already talked about protective stops as well. If you want to read these things, you can read these important points. These points are important from your CMT exam point of view, so you can read that if you want. Now let's talk about trailing stops. So trailing stops are also known as progressive stops, and we use trailing stops to avoid the potential loss of profit, right? To avoid the potential loss of profit, we use trailing stops. So if we exit too much early, then maybe the stock would go up. Let's say if you exit somewhere over there, let's say if I exit at this point, which in my opinion is a top level, right? Which my opinion is a top level. But after that, if the stock goes up, which in this case has gone up, if the stock performs like this, then this is a potential loss, right? Because you could have taken more if you had holded your position. So our trailing stop loss should be such like that it helps us to, ride the trend as much as possible. Now there are some methods to take this trailing stop in our charts. So there are some tools which you can use to put trailing stops in the chart. So some people use Parabolic SAR, some people use Trendline, some people use Chandelier exit, some people use average true range, some people use percentage gains. These are some of the important methods and the famous ones which we are going to discuss. So first let's talk about Parabolic SAR. Now let me go to this indicator tab and I'll type Parabolic SAR. So let me just put it up. So this Parabolic SAR indicator has been made by Wells Wilder, who has made ADX as well. So he has made very good indicators, and this Parabolic SAR is known as Parabolic SAR because these whenever the stock goes up, this line looks like a parabola. This is why Wells Wilder said that I would keep the name Parabolic, right? And SAR stands for stop and reverse. That's why we say Parabolic SAR, Parabolic stop and reverse. So it's a trading system where if the prices are above this SAR, then you would buy, and if the prices are below this SAR, then you would sell. I hope this thing is clear to you, and we can use this tool to trail our profits. So let's say if you had bought over there at this point, let's say you initiated a buy position at this point. So as per Parabolic SAR, you would have ridden this trend, and your exit would have been somewhere over there. When the Parabolic SAR line got changed, when it went up from price, then only we should have exited as per this Parabolic SAR method, right? I hope this thing is clear to you. So this Parabolic SAR method should be used as a trailing stop loss, and some people do that as well. So you can do that too if you want to trail your profits. This is one method, but there is one disadvantage of using this method, and that disadvantage is volatility. It does not take volatility into account. So when the volatility is high, it does not perform well. So we must backtest this Parabolic SAR on stocks or in commodities or in any financial instrument that you trade, and you will have to check whether this Parabolic SAR works in your instrument or not. So you will have to do that homework on your own, but this is one method which some people use to trail their profits. I hope this thing is clear to you. Now let's talk about Trendline. So Trendline is another method which people use to trail their stop losses. So now let me just unhide all of these things, and let me remove this SAR. Now to draw a trend line, we need a trend, right? So we need some small or some good trend. So I think I've got a one. Now this trend line is looking good. So let me draw a trend line. If I draw this trend line, then basically I would be able to write the whole trend. So let's say if I buy at this point, let's say I buy at the lowest point. Let me assume this thing. It never happens, but I'm just assuming that I have done that. So I have bought at the lowest point, and I am able to write the trend as per this trend line. And my exit would have been at this point if I use this trend line, right? So as per trend line, my exit at this level at 3,300 rupees level. So you can use trend line as well to define your exit and entry. Whenever this trend line gets broken, you can exit your existing position. So that's how you can trail your profits. I hope this method is clear to you. This method is also used very widely, so you can use that if you want. Now the third method is trailing stops using Chandler exit. Now to understand this thing, I would say that you should go to stock charts website first. So as you can see that I am there in stock charts. It's a very good website if you want to learn technical analysis indicators. So you can read about Chandler exit over there. So in the charts you can see that it looks like super trend to me. So it works that way. It's a line. So whenever the prices are above this line, then you should buy or you should hold your position if you have existing one. And whenever this line gets broken, you should exit your position, right? I hope this thing is clear to you. I will just tell you what does it use and how it is calculated. So basically it takes average true range into its calculation, right? So it takes average true range into its calculation, and average true range is all about volatility. So this Chandler exit is using volatility in itself. So it is a good thing and you can use that if you want. This thing is not very famous. That's why I have not put up this thing in TradingView. But if you want to know more, you can read there at stock chart, because it is not something that you will understand by just watching the video. You will have to apply it on your own. And this thing is applicable in other things as well, in other technical analysis concepts as well. Whatever I am teaching, please try to apply that. Now let's talk about average true range, which is another method which you can use to trail your stop losses. Now let's go to TradingView again and I'll type average true range. Average true range, I've got this thing. Now how does this average true range work? Let me tell you this thing. So ATR stands for average true range, right? So by true range, it means to say that it will represent you the true range of the market, and it is an average which tells you about the average true range. So here the length is 14, right? So it will tell you in the previous 14 period what is the average range, and it will plot itself based on that. So the idea behind the plotting ATR is very simple. Whenever the ATR is low, that means whenever the ATR is there standing at this level, it will mean that the volatility is low in the market, right? But whenever the ATR would go up, I would say that the volatility has gone up in the market. So that's how you can use ATR. So ATR tells you about the volatility of the market. I hope this thing is clear to you. Now let's use this ATR to understand how we can use it to trail our profits. So it should be used with some other indicators, like in this case we are using trend line. So when this trend line got broken, right? When this trend line got broken, then we should have checked ATR as well. We should check this one. So you can see that the previous level, which was this high, was broken. So let me draw a line. So you can see that this level was broken, and the ATR was broken. You can see that. So if the ATR is going up, then it is telling you that the volatility may rise, right? And volatility rises when the market goes down, because the market goes down very sharply most of the time, and it does not come up very sharply most of the time. So that's how you can use ATR as a confirmation tool to trail your stop losses. So the idea behind using ATR is very simple. Whenever any breakout happens, you should check ATR to know the volatility of the market. If the ATR is going up, and if within the ATR, if there is any breakout, that if you find that, then it will clearly indicate you that okay, the trend has changed. And if the volatility is going up, then it will also signify you a change, because whenever any breakout happens, volatility goes up, right? I hope this thing is clear to you. Now let's talk about percentage gains. So percentage gains is another method which you can use to trail your profits. Now how to use that, let's understand this thing. So let me just again put this up bar replay, and before that let's remove this ATR. So I will use this bar replay right over there. So you can see that the stock has made a high as per our historical data. And what I'll do is that I'll try to measure. I'll try to measure from this high point whether the stock can go below this 15% or not. So what some people do is that they just check what is the recent high, and they just check that whether the stock has fallen down from the previous high or not. So what some people do is that if the stock goes down 15% below from its previous high, then they sell out their position. So in this case, if the stock breaks out this level, if the stock goes below 15% level, then they would sell their position. So that's how some people trail their stop losses. I hope this thing is clear to you. Some people use 7%, some people use 10%. So this percentage can differ, but the basic idea behind using this percentage filter is very simple. People want to maximize their profit. That's why they want to exit as early as possible, and they don't want to suffer this potential loss, right? I hope this thing is clear to you. Now let's replay the bar and understand this thing. What would have happened? So as per this thing, you can see that the stock tested this level, and as per our percentage filter, we would have got a stop loss as well, and we will have to exit over somewhere there. But after that, what happened? Let us wait and see. So you can see that after my stop loss got hit, the market kind of fluctuated over there for a while, and then it has started going up. You can see that it has started going up. So sometimes you can get false signal as well if you use these percentage filter, and it is not a surety, but it is a probability. If you use a 15 percentage filter on daily charts, then you are most likely to get out very early on. As we know that technical analysis is a probability and no method is perfect. So I would say that you should understand the logic behind any method before using it. That would be my advice. So these were some of the methods which we discussed on trailing stop losses. Now let's talk about Whipsaw. Now Whipsaw is, I think, one of the most important topics of this chapter. So you must understand this thing. And I would say that our question from this Whipsaw topic is going to come. It is very likely that a question from this Whipsaw is going to come. So you must be able to understand this term Whipsaw, right? So Whipsaw is a kind of situation which occurs when an investor buys a security, the security prices fall down, investor sells the security, then the stock prices goes up above the purchase price. Now what did I say? Let's understand this thing, because this definition is maybe confusing to some people. So let's understand this thing on chart as well. Now let's take this example only. So let us assume that you bought at this point. I'm assuming that you bought at this point because you made your trend line, and you got to know that okay, the trend is good, I should buy it over there. You buy at a good point, and after that the stock went up, right? But suddenly you found that the stock has broken its trend line, right? So after the trend line got broken, you exit your position, you sell somewhere over there, but after you sell, the stock went up, right? So your stop loss got hit, but after that it went up. So you got a loss. For you, it's an opportunity loss because you are not able to take big profit. Had you hold it over there, then you would have made a bigger profit. But since you exited over there, your profit was very much less. I hope this thing is clear to you. So you buy the stock, right? So you buy the stock goes below your technical analysis level, and you sell the stock at a very small profit or at a loss, and after you take a loss, the stock prices goes up and you get whipsaw. This whole situation is known as whipsaw. I hope this thing is clear to you. Again, let me tell you about Whipsaw. Whipsaw is a situation where you buy the stock. Let's say you bought a stock at 100, your stop loss got hit at 95, and after your stop loss gets hit, the stock went up from 95 to let's say 120 or 130. You got a loss, but the stock prices went up. So these kind of things can happen with you, and if you trade in the market or you invest in the market, these things can happen with you. And with newbies, this thing is not very rare. This thing happens very oftenly. So investors or traders are right in such cases, but they lose money because their stop loss hits, and this it happens a lot of time. Whipsaw is something which is unavoidable sometimes, but if you try hard, then you can avoid it sometime. If you use good technical indicators, if you use good technical analysis, then you can avoid these things to some extent. Now let's talk about time stops. So time stops are exit stops used to close a position after a predetermined period of time has passed. I have given this example to you already. So after a breakout happens, what some people do is that some people wait for 2 or 3 period or 2 or 3 candle to check whether the breakout is real or not. So even after the 2 3 candle, if the prices are above the breakout, so they buy the stock. So this is something which I have explained very recently, so I hope this thing is clear to you. Now let's talk about money stops. Now what are money stops? What money stops are the stops in which our trader or investors put the stop based on the risk that one is willing to take in terms of money. Now what did I say? What does this definition mean? Let me tell you this thing in trading view only. So let's say you buy the stock somewhere over there because you see that okay, there is a resistance. So you buy at this level. So let's say that you buy at 4,000 rupees, right? So 4,000 rupees is your buying point. But now, so if I say that my risk capability is only and only 100 rupees, so if I invest my 4,000 rupee and if I say that I can't bear a risk of more than 100 rupees, I can't lose more than 100 rupees in any situation. So if I say that and if I do trading that way, so what will happen is that if the prices goes below 3,900 rupees level, then I'll have to exit because I can't take a risk of more than 100 rupees. So this is known as money stop, where you have decided okay, I can't lose more than 100 rupees or 500 rupees, so you keep a stop loss based on that. But as per technical analysis, as per the system, your stop loss would have been somewhere over there, and this level is 3,700 rupees level. So as per the system, you should have taken a stop loss of 300 rupees because your stop loss was at 3,700 rupees as per the system. So you will have to take 300 rupees stop loss as per the system. But since you followed a money stop loss, then if you follow that, then you would get out very soon. So it is not advisable that you use your money stops, because you should use your stop loss based on technical analysis, not on your psychological levels. You should not be carried away by these psychological levels, like I can't lose more than $100 or $500 or maybe 50 rupees. You should not have such things in your mind. Your stop loss should be defined by technical analysis. It should not be a money stop loss anytime. So from a strategic and money management point of view, it is a bad strategy. So you should not do that. And if you follow this money based stop loss, then a lot of whipsaws can occur, right? So I hope this thing is clear to you. Now let's talk about stops based on breakout. So a breakout above resistance or below support level signals a change in trend direction. So therefore, one must have a entry stop and a protective stop in breakout trading, right? So now let's understand how should we define our stop losses when we trade breakouts. So here I have taken again an example of Bajaj Finance stock, which I took very recently initially in the video. So here you can see that the breakout happened, right? Now what should be my strategy? Where should I take my stop loss or entry stop or protective stop? How should I place these things? So let's discuss about that. So let's say uh, this is a breakout candle, right? So one strategy is that you can enter it over there at this point, you could buy at this point. This is one strategy which is very common. And you can place a stop loss below this level, you can place a stop loss below this level. But if you place a stop loss below this level, then you can see that your risk is very much high, right? You are taking around 18% risk, and which is not advisable in most of the cases. If you are doing short-term trading, then nobody is willing to take 18% risk. But technically, this point is very much good. If you take a stop loss below this point, then it is very unlikely that your stop loss will hit, right? So if you take a higher stop loss or a deeper stop loss, then chances are very little that your stop loss would hit. But if it gets hit, then you will have to face a major loss, right? So this is one strategy which you can use. There is another strategy which you can use in stop loss, right? We talked about one strategy of stop loss. There is another strategy where what you can do is that you can place a stop loss below this candle. So this is one level where you can place your stop loss, right? So if you place your stop loss at this level, then there is a possibility that your stop loss will get hit, right? So there is a possibility of getting whipsaw, but the advantage is that your risk is very little. So let's say if I buy at this point, if I buy at this point and keep a stop loss over there, then my risk as per this system, as per this stop loss would be around 8%, right? So in my first example my risk was 18%, in my second example my risk was just 8%, but there was a higher probability of getting my stop loss hit in this second case. So these were the two methods which I told you about, stops, protective stops, and each method has its own advantage and disadvantage, and I told you that as well. Now we talked about protective stops, right? Now let's talk about our entry stops, which is where to buy, right? So what you can do is that you can buy at this level, right? So when this breakout candle occurred, you can buy at this level, right? But you can wait as well. You can wait to confirm that whether this breakout is real or not. So to do that, you can wait for 2-3 candles. You can say that, okay, let me wait, let me check whether this breakout is good or not. So I just played this bar, and I just played, and you can see that there is another buying opportunity which is over there. So you can buy at this point as well. You can buy at this point as well, and you can buy at the level where the breakout happened. So if you buy at the level where just breakout happened, at the breakout candle, if you buy, then what would happen is that your risk will be lower. Why? Because you will be able to take a smaller stop loss. But if you buy at this level, right, if you buy at this level, then your stop loss will be higher. So in this first case where I bought at the breakout candle, my stop loss was lower and my risk was lower. But in the second case where I bought at this level, that's where my loss was higher, right? So there are different techniques of entry which you can use. Some people, what they do is that they wait for a pullback or throwback to happen. So let me remove this thing. So as you know that this level is a very important level from technical analyst point of view. So some people, what they do is that they wait for a breakout, pullback or throwback to happen. So after the breakout happens, what they say is that let me wait for the throwback to happen, or a pullback to happen. If the throwback happens, then I would buy at this point, right? So some people would prefer to buy at this point. So why would they prefer to buy at this point? Because they want to minimize their losses. So to minimize loss, some people wait for a pullback or a throwback. So this is one strategy which some people use, and you can also use, but you may miss out the trend if the price does not, take a pullback or a throwback. You may lose money then. So what some people do is that some people buy 50% at this point when the breakout happens, and if 50% at this level, right? 50% at this level, and if after this stock takes a pullback or a throwback, then after the throwback happens, then they buy another 50% and they complete their full position. So some people use this strategy as well. There are various strategies which you can use as per your risk appetite, your risk management, and it's all up to you. No method is perfect or excellent, and you will have to develop a method which works most of the time, right? I hope this thing is clear to you. Now I think we have covered stops based on breakouts, and we have covered stops based on retracement as well, where we would buy a stock after a retracement, after a pullback or a throwback happens in an uptrend and pullback happens in a downtrend. I have told you this thing in my previous videos as well. Now let's talk about calculating risk to reward for breakout trading. So it's a no-brainer that our risk should be lower than our reward, and ideally our risk should be 3 times of our reward, right? Let's say if you are buying Bajaj Finance, right? If you take a stop loss of 200 rupees, then your minimum target should be 600 rupees. So if you lose 1 rupee, then you should be able to earn 3 rupees if you get right. So that's how your risk reward should be and it is very important to have a good risk to reward ratio. In academics it is known as reward to risk ratio, but generally people say risk to reward ratio, right? I hope this thing is clear to you. Now let's talk about false or specialist breakout. We all know that what a false breakout means, and why does this happen. Let's understand the psychology behind it, and let's also understand why do we say this a specialist breakout and how to deal with it. We will understand this thing as well. So let's go to trading view again. So here I have taken nifty 50 example, and it is a 15-minute chart. Why I have taken 15-minute charts? Because in short term intraday trading you will find a lot of fake outs or a fake breakout pattern. So here I have found a one. So you can see that there is a major support line which is there. So before it used to be a resistance line. You can see that how strong it was. The stock or the nifty 50 was taking resistance from there, but once it broke out, you can see that the stock started going up, then again it took a support at this point, and at this point it was a perfect buy. Why? Because you can see that this was a very important psychological level, and the nifty 50 took 2-3 times support or resistance from there. So it was a very good buy in my opinion. It may be not in your opinion, but in my opinion it is a very good buy. Now what happened? Let's see that. Now the stock consolidated, then again suddenly what happened is that stock broke down, right? So if I buy at this point, then my stop loss would have been somewhere at this point, right? My stop loss would have been at somewhere this point. Now I hope this thing is clear to you. My stop loss is hit, so ideally I should exit. Now let's see what happened after I exit. Look at this. I exited. Now you see what happened with the price. After I made an exit, the prices went up, taking my stop loss, and my view was right. I was right on the technical side, but for a while the prices gone down and it went up again, right? So that's what we call it as fake breakout or a false breakout. Why do we say that? Because it was false. Original hypothesis which I had was right, that the trend is up and the market should take support from this level, which it took. It just broke it for a while, and after that it went up, taking my stop loss. So I couldn't make profit from it because I exited my position very early on. So that can happen with you as well. This is known as a breakout or a false breakout. Some people call it as specialist breakout. Now why do people call it as specialist breakout? Let's understand this thing. Now as you can see in this example, this level was very much important from a psychology point of view. It was a very important support level, right? Now some people say that there is smart money, there are operators, there is big money, institution money, they control the market. People say things like this, and people say that these institutional investors have seen these levels. These people knew that this level was important, and people have taken a lot of positions uh, in there, right? By looking at this level, people have taken a lot of positions, and their stop loss should have been somewhere at this point. So what the smart money did is that they ate your stop loss. The operator ate your stop loss because he knew that your stop loss is at this level. So he deliberately took the market down by putting a lot of money, by shorting the market a lot. He took your stop loss, then after that he bought a lot, and the market went up. So that is why we say that these false breakouts are also known as specialist breakout, because these breakouts are created by these specialist or institutional or in operators or smart money. You can name them a lot of things, but these things happen especially in short term trading, but in long term trading you won't find it much. You may see that, but they are very rare. But in short term intraday trading, this thing is very common. I hope this thing is clear to you, and this thing is also known as specialist breakout. We have talked about what is a specialist breakout. Now the question is, how do we take advantage of that, or how do we protect ourselves from this specialist breakout? So let's look at that as well. Now, how to handle a specialist breakout? So, to protect the loss, investors or trader place another buy order. Investors or traders should place another buy order above the high of breakout to protect from losses and to make some profit. I should have written from. I wrote from over there, so it's a mistake. It's not from, it's from, right? Now let's go to trading view and understand this thing what was written. So you can see that our initial stop loss got hit at this point. Our stop loss was over there, so we got hit. So as per the definition, we should have entered again. We should have entered again at this point, right? So you can see that at this point the market took support from this level again, right? So it came back above from this breakout level and it was taking kind of support a lot of times. So we should have initiated a buy position over there, and if we had done that, then we would have made a lot of profit. So that's how you can do trading. So once your stop loss gets hits due to a fake breakout or a specialist breakout, you should enter again after you feel that there is an buying opportunity. I hope this thing is clear to you. Now if I conclude this chapter, in this video we learned what are breakouts, how to deal with breakouts, what are the strategies to differentiate between real breakout and fake breakout. We also discussed about some methods to analyze entry points and exit points, how to protect yourself from a specialist breakout or fake breakouts, how to deal with that. We also discussed about some entry points, some exit points. We discussed about some trailing stop losses, how to trail your stop losses. We discussed about that as well. So we discussed a lot of things, and I hope this video helped you a lot. If you have any questions, please comment me. I would be really happy to answer all of your questions. If you have any doubts and if you want to ask us something personally, you can contact us on Instagram as well if you want to ask some questions. And if you want to mail us and ask us some questions, then you can mail us as well. And follow our YouTube channel to watch more stock market and CMT related videos. Thank you for watching this video. See you next time.